There we go. So tonight, like I said, we're going to cover week number 3 of the Smart Money Concepts Bootcamp that we've been going through over the last several weeks. Right. So last week, just to quickly recap, what we talked about last week, we talked mainly about order blocks and imbalances or fair value gaps, right? How to identify them, how to wait for the market to retrace back into a zone, right? That has not every time they're going to both overlap, but that's a stronger confirmation that we're going to continue in the right direction, right? If you see an order block and a fair value gap in the same area, that's really kind of what you're looking for, and a very solid, a very strong entry point inside of smart money, right? So this week we're going to talk about how to execute a trade properly using smart money concepts, right? The first thing is top-down analysis, right? What is top-down analysis? We talked about, market structure and looking for liquidity sweeps and, fair value gaps and order blocks and all these things. But really what it comes down to is on the higher time frame, like the 4-hour and the 1-hour time frame, we want to look for market structure, right? Which direction is the market headed? Are we consistently trending higher, or are we consistently trending lower? Right? This is the most important step, because you want to understand if the market is bullish, right? If the market's trending higher, we want to be buying with the market until that wave dies down, and then, possibly switch up our bias and then look for some sells, right? And vice versa. If the market's in a downtrend, trending down, we're not going to look for buys inside of that downtrend. We're going to look to continue that trend all the way down until it flips, and then we can look to enter buys, right? So that's on the bigger time frame, like the 4-hour or the 1-hour. That's where I mainly look for market structure, just to give me an idea. Okay, which direction is the market headed, and then where do I want to enter my trades? Am I entering buys or sells? Right, then on the 15-minute, this is kind of, you can go either way with this. You can do the 1-hour, the 15-minute, 30-minute. You can kind of vary this up a little bit, but looking for a liquidity sweep and stops to be hunted, right? So looking for those areas where we have a lot of consolidation, right? An area where the banks are looking to take everybody out of the market before they move the market in the right direction, right? Because before a big move happens, we're going to see the market sweep in the opposite direction and then go in the desired direction where the banks and institutions want to push this market, right? And then on the 1-minute, 3-minute, and 5-minute time frame, that's where we look for an inverse fair value gap, right? And using the scanner that we have access to through Donnie, right, Donovan Taylor, one of the other educators inside of Primeverse, and that's where we look for our entries, for the confirmations, right? Obviously, we're looking for order blocks and fair value gaps and certain parameters that need to be met, which we're going to get into in a little bit. But this is kind of what the top-down analysis looks like, right? Higher time frame, we're looking for market structure. 15-minute, hourly time frame, 15-minute, we're looking for liquidity sweeps. And then 1-minute, 3-minute, or 5-minute, that's where we actually look to get into the market. All right, then internal versus external liquidity. This is an important thing because the banks and institutions, they target both, right? The external liquidity is something that, if we go to a chart here, for example, let's look at some external liquidity that we've had recently. All right, so over here in the last couple of days, just a couple of days ago, but we had external liquidity. And if we turn off all these, we had some external liquidity at these lows, meaning that when the market is up here, these lows are our external liquidity, right? And if the market is lower, we're looking to hunt these highs, right? Something like this, or even these highs, right? External liquidity is above current price or below current price on a bigger time frame, right? Looking for, is there a significant low or a consolidation where we can see the market sweep the lows before then continuing in the right direction, right? So for example, let's say all these people that were buying in here, right? Because there's a lot of people who are trading. It's not just the 50 or 60 of us that are on this call right now, right? But there's a lot of people buying gold all the way up here, right? A lot of different strategies that are being traded, a lot of different perspectives on the market are being traded. And there's people who are buying this all the way up, expecting these highs to be taken out, right? The external liquidity to the top. But there's also external liquidity down low here, right? Meaning that before the market can continue higher, at some point, we're probably going to take this low out, right? Depending on what the market is looking like. But what do we see after that, right? We see this high being taken, which is a strong confirmation that we are going to go higher, right? But because we have this external liquidity on the higher time frame, we see the market had 3 hourly candles that were just very bearish, right? This dropped in 3 hours from 51.71 all the way down to 50.28, right? And even the hourly candle after that, 50.12. So that's over 1,000 pips that the market dropped, 1,600 pips to take out this liquidity before then driving the market higher, right? Which we see here, the liquidity was taken and now the market went higher. So that's external liquidity. Internal liquidity would be, for example, we have all of these highs right here, right? We have highs here. We have this high that's being created as well. And then the market was down here. We moved a little bit higher, right? We created external liquidity because this is the low now. And we came down, created a higher low. So now we have external liquidity from here, right? But at that same time, we created internal liquidity right here because these highs are lower than these highs, right? Which we're anticipating to take out at some point. So this internal liquidity is just a lower high, right, than these previous ones that's waiting to be taken out. There's people selling, having their stop loss at this high, stop loss at this high, stop loss at this high, expecting the market to continue down, where really the market, right, we saw the market shift from bearish back to bullish. We swept these lows, created a lower high here, retraced, and then we went and took all these highs, took all this external liquidity, right? So the internal liquidity, you're looking for lower highs or higher lows that are consistently being taken out, right? And also right here, we can see we had equal lows here as well, which we ended up taking. This was also considered internal liquidity, right? Because that's liquidity that's a higher low compared to this lower low that we had before, right? So that's the difference between internal versus external liquidity. And both of these areas are being targeted all the time, right? We're looking for, where is the market going to sweep next? We're looking for the market to go from liquidity to liquidity, right? Because if there wasn't people buying when we are selling or selling when we're buying, the market would just continuously go into one direction, right? And that direction would be up because everybody would be buying and there would be no retracements or pullbacks, or the market wouldn't drop because there's no need for us to go anywhere because the market is just steady going higher. We're not creating any liquidity. We're not having people on the opposite side of us doing exactly what we're doing, but the opposite, right? If we're buying, they're selling. That's how liquidity is being created, right? The markets are letting people get into the market, right? It's not going to be fast. It's going to be slowly. They're going to let it build up for a little bit, and then they're going to take it all at once, right? So like, for example, just before we move on here, like we started and made these lows at about 10 a.m. and we made equal lows, right, at 5 a.m. And then we finally took that liquidity at 5 p.m. So this almost took an entire day for everybody to be able to get into the market just to be swept out and then for the real move to happen. Does that make sense? Drop a 1 in the chat if that makes sense. I want to make sure that we're all on the same page here and understand what we are talking about. The ones. Sweet. So let's go back to the slideshow here. And now trading sessions and volatility. Right, this is an important thing to understand when it comes to trading. And you probably saw earlier I had the trading sessions indicator on TradingView, right? And that basically, it's not an indicator that shows me when to buy or sell or do anything like that. It just shows me what time each session opens up, right? For example, London session, if we're in Canada or in the United States, in the UK, the markets are going to open at a different time than they are here, right? It's based off of what time do the banks open. So when the banks open in London, in Canada, where I am, it will be midnight when those banks are open, right? And that's when money starts flowing into the market once the banks are open, right? Then in New York, when the New York banks open, it'll be 5 a.m. here. In Sydney, right? The Sydney session, Australia, will be 2 p.m. here, and Tokyo session will be 5 p.m. here, or the Asian session, right? And you can see they go on for about 9 hours. And it's very important to understand this, which I'm going to bring up here again. We're just going to remove some of the stuff here. The reason why it's important to understand and something that you can follow is over a period of time, you're going to see the market react a certain way before a session starts, during a session, and after a session. Right? You can see some of these sessions overlap. So, for example, Sydney session is not on here, but Sydney and Tokyo, they overlap, right? And you can see London and New York session overlap for a few hours. And basically what this is showing you is at these specific times, right? So London session at midnight for my time zone, right? If you want to search this up, search it up in your time zone, right? It's going to be a little bit different. But at midnight, my time, we can see right here that London session, we had a spike up before we were bearish, right? Basically all through the first part of London session. And then when we overlapped with New York session, we saw a bullish spike leading into Tokyo session or the Asian session. We saw a small retracement, and then Asia session was very bullish at the beginning, died down a little bit, and then we went back into bullish. Right now, if we take a look at this, the previous Asian session from here, the day before, this was on Sunday when the market opened back up. Right, we saw the market on Friday was dropping, and then leading into Asian session when the market opened back up on Sunday night, we saw the first part or the first hourly candle of the Asian session was bearish, and then we ended off very strong and very bullish towards the end of the Asian session, right? We look at the next day, Asia session. We were bearish leading into the Asian session, and then towards the end and in the middle of it, we were very bullish. And then when it was starting to end, we were bearish again. Right? So very similar. Leading into Asia, bearish. Going out of Asia, bullish. Right? Same thing here. Leading in, bearish. Leading out, bullish. The next Asian session, leading up to it, we were bearish. Asia session starts, we were bullish again. Asia session ends, we start to go bearish. So you start to pick up on these different patterns, and it's not going to be like that every single time in Asia session or every time in London or in New York or Sydney session, right? But this is going to help you kind of see where the market is at and how it's reacting in different time zones, right? In different trading sessions, as we call it. And here, for example, as well, the last couple days, actually during Asia session, we've seen the market be bearish, bullish, have a little bit of a pullback, and then going into London session, we start to be bullish again, right? And then here again, we see we were bearish going out of New York session today, leading into Asia session, we were bullish, and now we are bearish again. Right, so definitely something to take into account and into consideration when you're looking at the charts and understanding, it's like, okay, which time zone or trading session works best for me, right? Am I somebody who's able to, trade in the morning for London session and New York overlap, right? That's for my time, for example, 5:30 in the morning is usually 5:30 to about 8 a.m. when the market moves the most, right? Or when you see a lot of action happen because it's London and New York overlap, or do I want to trade in the evening after I'm done work, or after I've done my commitments, whatever the case is, and then focus on the charts then, right? Pick a specific trading session that fits best towards your schedule, right? And from there, focus on that specific trading session, and you're going to see that your trading is going to improve drastically because you're going to see the consistent market movements, how it's reacting, going into the session, leaving the session, before the session even starts, right? And this way, you'll be able to see the market more consistently at specific times of the day, right? There's times of the day where I don't even trade because I know I'm waiting for this to happen, or I'm anticipating that Asia session is going to be bullish, or London session is going to be bearish, whatever the case is. And this can flip from time to time, but as you can see, it's very consistent for majority of the time. Right? For example, going into London session, right, we had a bearish start, and then we ended bullish in the London New York overlap, and the New York session was bearish. London session, we were bearish to start. Into the New York overlap, we were bullish, and then we were bearish during New York and after New York, right? And then leading into Asia session, the same thing. Going into London session, we were bullish. London session was bearish, and we didn't really have a pullback here today. It was just very bearish all day long, right? So definitely something to keep in consideration, and practice it. Go on a demo account if you want to try this out and back test it and see how the market reacts in a specific time zone. You want to switch it up a little bit and start trading only a specific session. Go on a demo account. It doesn't hurt to go and try and back test and see what works best for you. The worst thing that you can do is try something new, try to jump into Asia session or trade right now, and expect an outcome and then not go your way because you don't have the knowledge or enough practice at that specific time zone to be able to be consistent there. All right, I want to just check the chat box, see if we have any questions. If you guys have any questions, feel free to drop them in the chat. I'll be looking to make sure I don't miss anything. But that is the trading sessions. And depending on what trading session it is, for example, during London session and New York, usually there's a lot of news events in those times, right? Early morning or mid-afternoon. So definitely something to keep in consideration when you're looking at these different time zones as well. All right, so the entry confirmation, the 3-step entry model. This is something that we kind of talked about, and I learned from Donnie as well, and saw very consistently how the market reacts from an area using the 3-step entry model, right? So you understand that we are in an uptrend or in a downtrend, right? That's not step one. That's what we want to do before we even look to enter the market, right? We have to understand which direction is the market going, and then from there, we want to see step one is, do we have some kind of liquidity being taken, right? Do we have highs being taken or lows being taken? And is there, right, liquidity on the opposite side that we can go and capture, right? If we're in an uptrend and we want to continue buying, we want to see sell side liquidity taken first, right? So we want to see the lows taken out before we continue higher. The second step we want to see a market structure shift on a lower time frame, right? And we're gonna make this all make sense in a second here. I'm gonna show you an example of what happened yesterday, a beautiful trade that played out, and today we had a few as well. But after the liquidity was taken, right, do we have a market structure shift on the lower time frame? So instead of the market taking the liquidity and then continuing lower, right, if we're looking for buys, we want to see the market take the liquidity and then create a new high, right? A market structure shift. So shift the market back into a bullish market. We want to look at that on a lower time frame, usually about 15-minute or 5-minute time frame is what I look for. And then we look for an order block plus a fair value gap that's filled within minimum 50% retracement, right? So those are your 3 steps. And then to enter into the market, we want to use the inverse fair value gap scanner, right? So what that means, the order block plus fair value gap filled with minimum 50% retracement, is after the market shifted, right? We took the liquidity, we shifted back into a bullish trend. Now we want to see, is there an order block and a fair value gap, or either or, that was left behind on the move to take the highs when the market shifted, right? And we want to see at least a 50% retracement into that specific area. And then to actually enter into the trade inside of that order block or fair value gap, we want to see an inverse fair value gap being taken on the scanner that we have inside of TradingView. All right, so that's your entry model. That's what we want to look for. We're going to show a few examples. I'm going to show one example from yesterday. That was a very clean setup. And the last thing I want to cover with this as well is we want to always put our stop loss beneath the low and your take profit at the opposing liquidity, right? So if we just took lows, we see the market shifted higher and we retraced minimum 50% into the order block or the fair value gap. We have the entry using the inverse fair value gap scanner. Our stop loss goes beneath the closest low, and then we look to target the highs on the opposite side. Risk to reward. This is an important thing before we show the example, right? Once you set your stop loss, do not move it unless you're moving it into profit or break even, right? Don't set your stop loss lower or higher because you think, oh, I need to give the market some more room to breathe. The market's going to come and chase your stop loss every single time. All right, sometimes you might get lucky, but in my experience, that's not usually the case. Is once I set my stop loss, I leave it where it is. There's a reason why it's there. We're targeting a certain risk to reward ratio, right? We want to aim for a 1 to 3 risk to reward. So for every $1 that you're risking, you're making $3 when your take profit gets hit, right? So let's say we have the low, we want to risk $100. Now our take profit at the opposite end at the highs, we want to see that be a 1 to 3 risk to reward minimum. That way, if we lose $100, we're going to win $300, right? And that way, if you take 10 consistent trades using this entry model, using proper risk to reward, right? Let's say we lose 7 of those trades, right? We have a 30% win rate, which if you get a 30% in school or on a test or, whatever the case is, if you get a 30%, you're failing, right? You're not going to get the certificate or pass your course or whatever the case is. But in trading, if you have a 30% win rate, you can still be profitable. Why? Because let's say we risked $100 every single trade and we lost 7 out of 10 trades, right? So now we lost $700 on our account. But our take profits, we have 3 of them get hit at a 1 to 3 risk to reward, meaning every take profit we hit $300 profit. Our net profit is still $200, right? Because we made 900 and we lost 700 with the 7 trades that we lost, we're still in profit $200, right? This is why it's very important to keep a consistent risk to reward, because you could be, failing, so to say, and have a losing, win percentage, but still be making money and still be profitable, right? And risk consistency. You want to stay consistent with the amount that you're risking. You don't want to risk $50 one day and then you make, or let's say we risk $100 one day, we make 300, and you're like, okay, I have $300 more in my account. Let's risk 200 today to make 600, right? If you lose that one trade rather than win, you're only now $100 in profit in two trades, where you should be at least $200 in profit, right? Yes, if your trade hits, you're making more money, but to be consistent and to follow your trading plan, risk the same amount every single time. Be consistent with that. Don't move your stop loss unless it's to break even or into profit when the market has moved into your direction. That way, if the market does reverse, right, we're not losing money where we don't have to. And then always target a minimum of a 1 to 3 risk to reward. So now to the example that I wanted to show you guys. So this is some screenshots I took from my MetaTrader last night when I saw the market developing here. And what I saw was we had some external liquidity here. All right, looking at this first picture on the left here, we saw equal lows here, right, which we had taken before. This is on the 15-minute time frame, right? We're looking for liquidity sweeps. We've seen this market absolutely drop. And on the higher time frame, this is actually an area that we were looking to buy from, but we were waiting to see how's the market going to develop, right? We saw the market take that liquidity, drop lower. We eventually ended up making a low, which brings us to the 5-minute time frame, right? We created the first low, the first sweep. Then we created a high here. Then we went a little bit lower, again, took out some more liquidity, and then we went higher, right? This is where step 2, we had step 1, liquidity was taken. Step 2, the market structure shifted from bearish back to bullish. And now, if we go over, we're looking for some kind of fair value gap or order block to take our trade from. Right, this is also on the 5-minute time frame. We see here there's a gap in the market, right, which we ended up trading into. We actually traded a little bit lower than that as well. But the reason why this is important is because on the 5-minute time frame, we didn't get a strong inverse fair value gap play, right? We want to see, usually I look for 1 minute, 3-minute, and 5-minute. If I don't get it on the 1 minute, or if I don't get it on the 5-minute, but I get it on the 3-minute and 1 minute, that's okay. It doesn't always have to be every single time frame, but I want to make sure at least 2 of them are lined up and showing me the exact same thing, right? So here in this example, right, we took liquidity, step 1, right? These lows were taken. We shifted the market back to bullish with this market structure shift here. Then we had a gap that we can see. I also pulled a fib from the low to the high. This gap was right below 50%. We actually ended up getting 618 retracement and even lower, probably almost a 786 retracement. And then we saw right here, which we're going to show a little bit closer. This is where we had a fair value gap being created, right? We talked about the 3-candle fair value gap, the wick from the first candle. Then the second candle is that big candle that creates that gap. And the third one shows us where the gap ends, right? So right here, we have that gap created. That gap got inversed because this candle closed above this gap. So our entry would have been at 51.47 roughly. Our stop loss would have been beneath this low at 51.37. So we're risking 100 pips. And then we're looking to target the highs, right? The highs were at 51.74. That was that high that was there. And we can see that after that was taken, right, we're also seeing here on the 1-minute time frame, we had this gap being created here. which was then inversed right around that same time, where on the 5 minute was at 147. This was here at roughly the same price, 145. If I had to guess where that is, in between 146 and 144. 145, 147, we see both time frames inverse that fair value gap. And then this screenshot right here is this right down here. So we can see if we entered from 147, by the time that this was already playing out, we were almost at these highs, right? So if we would have entered here, stop loss beneath the low, we never even came into any drawdown. We just basically went up, closed above these highs, which is a strong sign. We retraced a little bit, and then we continued higher and actually ended up taking these highs during the night, right? Which I'll show you guys the final result of that here as well, just so you guys can see this. Right, so that was right here. Remove this. We saw these lows is what we were looking for to be taken out, right? We higher time frame, we know that we're in an uptrend. We were looking for this liquidity to be taken. We had the lows taken. On the 1 hour time frame, we had a little bit more of an aggressive move on the 15-minute time frame, right, which is right here. The lows were taken. Now we went to the 5-minute time frame. Right here, we see this was the sweep. We had our high here. This was our market structure shift. Then we have our gap here that we're looking to trade into, right, which we ended up trading into. Now let's take our Fibonacci, see what our retracement level is from the low to the high. We ended up getting a 716 retracement, right? And then on the 5-minute time frame, we can see this smaller gap, the one that we're looking for right here, got inversed when this candle closed above this fair value gap. That would have been our entry, which we're going to show right here. A long position, entry from this high, or from that candle closure. Our stop loss would be beneath this low. And then we're looking to target these highs right here. That was a 2.7 risk to reward trade right there, which actually, right, obviously we're looking for these highs to be taken out. But if we stretch this across a little bit more, this actually ended up playing out to be a 4.3 risk to reward ratio trade right there. Right, following our exact entry model, we've seen, if we zoom this out a little bit, right, liquidity was taken, a high was created, we moved lower again, structure was shifted, we retraced into this gap, we got our confirmation that we have at least 50%. The inverse fair value gap scanner called out our buys here, stop beneath the low, target these highs. That was roughly a 1 to 3 risk to reward ratio if you just targeted these highs, right? You could also have targeted these highs back here, and that would have given you your 1 to 3.5 risk to reward. Does that kind of make sense? Drop a 2 in the chat if you guys are following, if that makes sense, if you understand how to use the A plus or the 3-step entry model, right? This is what we're looking for, is the market is moving from liquidity to liquidity, right? We see liquidity being taken down here. Now we move to take the higher liquidity, which we ended up taking out there, right? We seen the market pull back a little bit, back right to our entry zone, but we never had any kind of drawdown. This went into profit and basically went straight to our take profit. All right, so now let's look at an example. We'll go back on the hourly time frame for this. All right, we'll remove all of this that we just created here and see what is the market showing us right now. Right, so now that we created more highs, right, we're looking for where can the market retrace to next? Where can we get an entry here? Let's go back to the 1 hour time frame. We know that we're in a bullish market, right? We had this zone marked up for a while right here. And sometimes your zone, your area won't be respected like you want it to, right? Sometimes the market will move where it wants to, right? But the same thing applies. So here we had some equal lows right here. We had liquidity here, right? These lows. We were wanting to see some kind of sweep beneath these lows to then trade into this order block that we have here. And we also had this fair value gap right here as well. Right, so they overlap there. We're waiting for the lows to be taken, which we ended up taking. Now, where do we find our entry? All right, the initial trade that we had called out, that Donnie called out today, we see that the market traded into our zone, and then we see the reaction higher, right? We see that we actually had this market or this candle go all the way down, wick down to 5109, but it closed at 5133. All right, so let's see what happened there on the smaller time frame. We'll go to the 5-minute because we know that we already took a liquidity sweep. Right, on the 5-minute time frame, we didn't see these highs get taken out, but we created this little high here, which then ended up being taken here. And then we see, let's mark this up here. Trend lines. We see the market got shifted back to bullish here. And then in this case, we actually entered this off of a smaller time frame. Right, off of the 3-minute and off of the 1-minute is actually where we got our entry here. We see that we had a gap here after the market was shifted. We were looking for this gap to be traded into. If we take our Fibonacci as well, just to see where that is, we'll take this high because we barely touched into that zone, created a new high, and then we came down and actually filled that area. We ended up getting a 786 retracement here. All right. On the 3-minute time frame, it actually inversed at around 5132.5. That's where we had the inverse fair value gap play out, which we'll mark up here as well. It would have been something like that, actually, a bigger gap from this wick. This is the big candle to this wick. That's our gap. But on the 1-minute time frame, zoom this down a little bit more even, we saw that this had actually inversed right around 30, and we had called out buys off of this retracement into this zone again at around 25. Right, so the reason for that being is we could have taken a trade off of 30, right? And then take profit 1 and 2. But with a stop below this low, what we ended up looking at was we left another massive gap here in the market and we created a new high. We were waiting for the market to drop back down, back into another gap to then go and take that trade, right? And then we looked for a inverse fair value gap. So if we mark this up, we have this gap here. We also have this gap a little bit lower here, right? It's for you to see, okay, which gap do we want to look for a trade out of? We're looking for the inverse fair value gap at the end of the day to take our trade, right? We're not looking to take it as soon as we get into this zone, because if we would have taken this as soon as it got into the zone, we would have dropped right down. All right, we wait for the inverse fair value gap. We saw that right there on the 1 minute time frame. Now we take our long position. If we would have entered right around there, stop loss could have even been right at this low, targeting the most recent high. We didn't quite take that. We actually ended up being taken out in break even here, and then the market actually ended up melting quite a bit. But even that setup right there, if you would have got in there, that's a 2.5 risk to reward ratio that we were aiming for. We were actually aiming for a little bit higher, to about 51.64, but we had first take profit at 30, or at 33, and then at 36, and we see that both of these take profits ended up getting hit. And this played out for a 1 to 2.36 risk to reward ratio, right? Obviously, it didn't end up taking these highs, closing above an area that we were looking for, and then the market melted in the opposite direction, right? So that was still a setup that we were able to take, a very clean setup. It didn't go all the way in our direction like the previous one did that I showed you guys, right? But now we see some more stuff happening. I'm going to take a look at this last one here and then go from there, right? So now we see we have lows here. That's liquidity. We have all these lows that we created on this move higher. That's liquidity. We see these lows back here from Monday got taken out, right? That's liquidity. We saw all this liquidity being taken, and now we're looking for where could the market possibly react from. If we go, we'll stay on the 15-minute for this, just for this example here, and then drop down to the 5-minute after. We see that we had a high being created, and then the market went and swept those lows. We see that that market structure shifted back to bullish. Now we can also take our fib, take it from the low to the current high that we have, which is at 51.28, and look, is there some kind of gap or area in the market that's an order block where we can potentially trade out of, right? At least 50% retracement. I can see 1 or 2 right off the bat here on the 15-minute. We see that's our gap that we could potentially look for trades out of. All right, let's just get rid of all of this. We see liquidity was swept, market structure was shifted. We have an order block here. If we go down to the 5-minute, we can see we actually have some gaps left behind a little bit lower as well, right around down here. Personally, I wouldn't like to see the market come down here. We'd probably end up going lower, even lower than we already did. But this is a strong area on this 15-minute order block. because we're also right here at these highs that we ended up shifting, right? So this is a strong support level right now on the 15-minute time frame. So once the market comes into here, I would want to toggle on the inverse fair value gap scanner, go down, right? You can even set an alert at this time, which I'm going to do at 5,096.5 is where we're going to set that alert. Why is it not letting me do that? I have to try and figure that out why it's not working. But set an alert at 5096.5. And once it gets into this area, into the zone, wait for a reaction on the 5-minute, 3-minute, and 1-minute using the inverse fair value gap scanner. And then that is our confirmation, right? Why? We're using the 3-step entry model. We have liquidity sweep. Step 1. We have market structure shift. Step 2. We're looking for at least a 50% retracement, which is right inside of this order block. That's step 3. Now we wait for the inverse fair value gap scanner to show us our entry, and then we're looking to take these highs and possibly even beyond and taking back at these highs that we had previously, right? But aiming for these highs, you can even set your take profit at these highs. Let's say for this example, we'll set this up. Let's say we got 50%, and then the market gave us an inverse fair value gap at around 95. Let's say stop loss is at 85. We're looking to target this high. That's a 1 to 3.5 risk to reward ratio, just targeting this high using our 3-step entry model, waiting for the right confirmations, letting the market set up in our zone, give us the inverse fair value gap confirmation, and then entering that trade there. All right, and you can manage your trade how you would manage your trade, right? If you want to aim for these highs, if you want to aim for even higher as well, I believe that we could over probably not tomorrow, but over next week, potentially even see these highs taken at 52.37. That's my outlook on this market as of right now. Obviously, things can change depending on how the market goes tomorrow, but this is the setup that I would look for during London session and New York session, depending on how this plays out over the next 3 hours before London session starts. Does anybody have any questions? All right, we covered a few different entries, a few different areas. Why are stop loss at previous lows / highs? You want to give the market some room to breathe, right? So let's say the reason why I put the stop loss here and not here, we want to look for the most recent low that is created once the market comes down, right? Once we get the retracement back in here, let's say we did get our inverse fair value gap right here at 50.95. You want to put it at the most recent low because you want to give the market some room to breathe. You don't want to, put it right here at 30 pips because that's how much you want to risk. You have to give it some room to breathe and adjust your lot size, not your stop loss. Because if we also had this down here at these lows, we wouldn't even have a 1-to-1 risk to reward ratio because our stop loss is so much bigger than our take profit, right? So we want to see where is that low that's created once the market comes down into our zone. Where is the inverse fair value gap being called out? And then find, okay, where do I put my stop loss depending on where my entry was, right? So something roughly like that. Because you don't want to have a massive stop loss where now you're 1 to 3, you're aiming for, new all-time highs or something like that, right? You want to make sure that it's evenly spaced out. If it is 100 pips, right, and that's too much on the lot size that you use, lower your lot size a little bit, right? And make sure you do this every single time. Right, make sure to wait for the low to be created inside of the zone, and then wherever, like let's say we get a trade where the inverse fair value gap only gets called out here, it's still in our retracement level, our 618, 716, 786. That's our kill zone where we would like to see the market react out of, right? Or where it reacts out of more consistently. But we need at least 50% in order for us to be confident and take that trade. But if it is down here where we get the entry, now you're adjusting your stop loss based on where the low was that was created. All right, so always move with the market, never move against the market. And make sure you always have a stop loss because that is very important. Don't take a trade without a stop loss. Does anybody have any questions before we jump off here? I want to make sure that you guys have all of your questions answered. How do you properly place a Fibonacci retracement? Good question. Let me share my screen again. And yeah, stop loss is always important. There was, back when I first started trading 4 years ago, this was like, I was having so much fun because I was making money. And I put $2,500 into a trading account. And the next day after I put it in there, I was actually on my way to Orlando, Florida, and I had made $1,000 and paid for my entire trip with one trade. Right, I was ecstatic. I was so excited, happy. Just paid for this whole trip through trading. And the next day, I entered a trade, and I forgot to put a stop loss, and my entire account was wiped. All $3,500, the $2,500 that I had put in myself, the $1,000 that I had made in profit the previous day, everything was gone because of one simple thing, right? It was similar to what happened here. Is the market just continued going in the opposite direction until I had no more money in my account. Right, so that's a lesson that I had to learn. I'm glad I learned it very early on. I think that was within my first 2 or 3 months of trading, but definitely something I will never do again. Right after losing that much money that quickly, and I had thought I had my trip paid for. Turns out I went home in debt. Like that's kind of how that ended up. But definitely a good learning lesson. As if you are a beginner trader on here, it's within your first year. I would say make sure you have your stop loss. You're following your trading plan. You know which trading session you're trading in, right? And make sure you execute. Move your stop loss to break even. Everything that the educators talk about, everything that we try and teach you guys, like it's very, very important because we have learned from the mistakes. We've been there, we've done it. It's not a good feeling when it happens to you, and we don't want that to happen to you guys as well, right? Because that possibility is out there. But let's get to the question here. Where do we place our Fibonacci? Right. So what we want to do is when we see step one, the liquidity sweep being taken, right? This is right here. We see the sweep. We took all those lows. Now we have this little high here that was created. We also have a market structure shift, right? The market shifted higher. What we want to do is from the low that we ended up getting on that liquidity sweep to the high of where the market structure shift ends, right? As of right now, we got a pullback here. So this is the current high of this market structure shift, of this move higher. We want to take it from the low to the high, right? If this ends up moving higher and then pulling back into this area, we want to now move our Fibonacci wherever the market goes, right? If the market goes up to here is 51.48, before we enter into the zone and get a 50% retracement, we want to move this higher, right? But if we do get a 50% retracement here, then it's obviously in our zone. We have 50%. Now we're looking for confirmations to continue this market higher. Does that make sense? I'm gonna flip this the other way as well, where now if we're selling, right, we have these highs that were taken out, right? We see this move higher. This was our liquidity sweep. We see that the market structure has been shifted here, right? We made this low, market moved higher. We broke lower here, right? Created that market structure shift lower. We pull our fib from the top of the wick to the bottom of where the market is currently at. And now we're looking for a 50% retracement, at least here, into our zone. And then we can look to continue the sells lower. All right, so from where the liquidity sweep ends to where the market structure shift ends before we get into our 50% retracement, that's your range for your fib. Does that make sense? Hopefully that clears that up for you. Experience is the best teacher. Same thing happened to me last December. It definitely happens. I see a few people have had that same experience. It's not a good one, let me tell you. For those of you that haven't had that, I hope that you don't. Can I see your fib settings? I will put those up there shortly. If you want to take a screenshot or take a picture of it, those are the zones that I take. Obviously, we have 0 and 1 is in gray. That's kind of the outside perimeter of the fib. Then the 382, this is kind of like where we see a lot of reactions from the 382, but they're mostly continuations until we see the next high or the next low before we then come into 50%, right? 50% is green. That means green light. We're looking for entries, possibilities of is the market going to react from here? And then 618, 716, 786. I have these in purple. You can choose whichever colors you want as well. But this is, for me, the kill zone, right? This is where the market reacts out of majority of the time, right? The two trades that we looked at prior to this current setup that we have here, we've seen the market react out of 618 and 716 on those two trades. And then the 886 is the red. I have that set up. This is our Black Friday discount, we call it, right? So this doesn't happen very often where the market will retrace that far down. But when it does, and we do get that reaction from there, that's like the best possible entry that we can get, right? It's rare. It's like Black Friday happens once or twice a year, and we don't see it very often. But those are my setups there, right? 382, looking for, are we going to just get a continuation off of here? And 50%, that's where we get the green light. 618, 716, 786 is the kill zone, and then 886 is the Black Friday discount. This is your last chance to take a picture or screenshot if you want those settings. But yeah, that's what I've found to work the best. That's basically what I started learning on the fibs was these retracement levels, and using these specific areas has helped to see where the market reacts from a lot better, a lot easier. And you start to notice the different zones where the market reacts from. Right? 50% minimum, we need that before we enter trades inside of our zone. 618 to 786 is our really good, consistent. We see those happen quite a lot. Where we would prefer to enter from, or the retracement we would like to see before we enter, but we don't always have to get that. And then 886 is the Black Friday discount. But yeah, does anybody have any final questions? Do you always clean up your chart? I usually do. Sometimes I'll leave some markups up there just so I can see. I don't take every trade that I mark up. I look to see different areas or zones to see, okay, did the market react from here? Was it something that I should have entered in? I look for all the different all of the confirmations, make sure the three-step formula is there, but I don't always or I try to always clean up my chart because a clean chart lets you see all the data, lets you see everything that's going on. You kind of have a clear eye to see everything that's going on. Because if you have a lot of different boxes and lines and charts and fibs and everything, it gets kind of messy. It's kind of hard to see what's actually going on. Um, so that I try to always clean my chart when I can. I don't know. Yeah, you can flip the chart. So if you, let's say you're somebody, and we're gonna end on this as well. But if you're somebody who, let's say you notice in your trading that you're more consistent with your trading when you're taking sells, right? That's where you see, okay, I can understand where the sell setup is. I understand, or maybe you're opposite. I understand where the buy setup is, right? This fits perfectly for me. If you're seeing the market, like for example, here we have a buy that we're looking on. This is the chart for gold, right? We have liquidity sweep, market structure shift, our fib, our order block. We're waiting for the market to pull back. If you're somebody who maybe you can't see this as well for buys, but you understand sells really well, you just hold on your chart on the side here on the numbers, and you put invert scale, and then it flips it for you, right? So now, okay, your eyes can see the sells better than buys. Okay, we flip this. Now it's the same thing, but in sells, right? We still have to remember that we're buying when we enter into the market, right? Flip it back to see, okay, where's the entry, stop loss, and take profit. Um, but this way, if you can see the sells better and we're looking for buys or the market's at a low point, flip it around, look at how the market's reacting, and then before you take the trade, flip it back and put in the proper parameters. So it's a very, very unique tool that you can use because I know in the beginning for me it was really hard to see sells and I was really only looking for buys on markets. And this helped me when the market was at a high point and we were looking to sell. I just flipped it the other way and I was like, oh, this is a perfect buy setup here. Let me put in the parameters for the sell, right? Because I just flipped it back to look at the numbers and make sure I put everything in right. So it is a very cool, very unique feature that they have on TradingView. Very useful, very useful as well. But with that being said, guys, I hope you all enjoyed week number 3 of the bootcamp. Next week will be week number 4, the final week of the bootcamp. And then after that, we're going to be doing some live trading, looking at a few things, marking up some charts together, looking at some setups. If you guys have some things that you want me to look at, your own setups, we can do that as well. And yeah, we're just gonna have a fun time. We're gonna trade together and continue to learn, continue to grow, and learn how to use the smart money concepts, which is something that I'm passionate about. You guys are passionate about it as well. If you guys are here, depending on where you are, it might be early morning. Seeing we had a lot of different places on here tonight. Could be late at night, but you made the decision to be here, to learn, to grow, and that's what we're going to continue to do every week. So I hope you guys all have a great rest of your night, and I will see you guys next week on Thursday again. Bye for now.